Suffices to say that based on the experience that we had from Imperial Bank, the IT was in some sense compromised and so forth. We wrote to all auditors.
Yes.
Sometime in November 2015, asking them that in the context of the audits that they were going to undertake, that is the audits for 2015.
The full year audits.
The full year audits, they are statutory, they're mandated by law. And we reminded them that they needed to do these audits according to the standards that are there, long established standards, which is IFRS. And also we asked them to also confirm to us or to write a report about the status of the IT framework, meaning how robust is it, and is it compromised and so forth. In that context, what then happened is end of March, the auditors came through, signed off with the management on various audits of all the banks. And one of the things that appeared consistently was a lot of the auditors pushed management on the classification of some loans. So loans were improperly classified. Now, they always get misclassified, to the advantage of the institution. So in effect, there was a lot more classification of loans, meaning non-performing loans, than management of this bank.
So you were saying it wasn't, NPLs weren't being accurately presented.
Exactly.
Yeah.
And it's not just NPL technically, but even, in any event. So put on the watch list or whatever it is. And consequently, they provided for them, banks provided for them, and some of them, as you know, showed large losses. As you know, markets, for the most part, did accept that. Shocked. This is the second time I'm told when a lot of banks have showed weak outturns at the end of the financial year. It seems to me that banks had always been showing huge profits, and as I have said before, there was a sort of a race to even show higher profits, than the one that has just revealed, their numbers and so forth.
That's right.
For once, or rather the second time, there were a lot of loans that were, or a lot of losses that were reported. The market sort of moved on. And in a sense, this is positive because, and the market saw it this way, I'm sure you'd agree that this was a cleaning of the balance sheet.
That's right.
So in effect, now the balance sheets are cleaner, and the banks can do truly banking business, as opposed to sort of try and push up lending rates so that they can hide some of the losses that they are inevitably having from these NPLs. So in a sense, we are in a much better place. But that didn't quite happen for the case of Chase, because there were some questions relating to loans which in the end related to let's say some of the directors. And when this were being investigated, it became clear that the directors needed to step aside, which they did, these two directors. And then in terms of reporting, the management was not quick in reporting the numbers correctly, meaning, it took them 2 days to report the numbers correctly, meaning indicating that the auditors had an opinion on this, which is the disclaimer of opinion, as it is called technically by the auditors, which really means that the auditors do not believe that they do not believe that the audits, the numbers that have been shown, are really true and fair representation of the business. But that's
a pretty damning situation.
And if you have loans in the order of 10 billion or 8 billion that you cannot understand, and then you have another 3 that you don't know where it's coming from, hey, these are not immaterial. These are material changes.
It's more than the entire capital.
So it's important, therefore, so I think the auditors in this case, yes, they made the right call and so forth.